$13.80. The trade desk fell 21.9% in one session down to a 7-year low, and it happened right on the earnings date everyone had circled. What's up, guys? Coach B here. Welcome to the breakdown. Today it's the trade desk, ticker TTD, and this one's a good lesson in a trap a lot of traders fall into. You can be completely right about the story and still get run over on the trade. Quick reminder up front, this is education, not financial advice. I'm not telling you to buy or sell anything here. Do your own research. Let's look at the chart first. The trade desk closed Thursday, August 6th at $17.67, then reported after the bell. Friday it opened at $12.87, rallied intraday to a high of $14.57, then faded back to close at $13.80. That's down 21.9% on the day, a 7-year low. Volume over the 3 sessions before averaged around 17 or 18 million shares. On the crash day, it hit 133 million shares, about 7.5 times normal. Now, here's the part that matters, because a lot of people will call this just a bad quarter. It wasn't really about the quarter that already happened. Revenue came in at $715.1 million against a street estimate of $752.1 million, only about 3% growth year over year. Way below what a growth stock is supposed to put up. Adjusted earnings were 34 cents a share against 40 cents expected, down about 17% from a year ago, and margins compressed hard. Operating margin down to 14.2% from 16.8%. Free cash flow margin down to around 19% from about 40.1%. But the number that actually crashed the stock was the guide. The trade desk told investors to expect at least $650 million in third quarter revenue, a decline of about 12% year over year, and about 19.4% below what analysts were already modeling. That's a growth story getting repriced into a shrinking one in real time. A 5% revenue miss doesn't take a stock down 22% by itself. A guide that says the deceleration is getting worse, not better, does. And here's that paradox I mentioned. You could have believed everything true about the trade desk, one of the biggest names in independent ad tech, still profitable, still growing, and you'd have been right about the company. But the market wasn't grading the company that day. It was grading the rate of change, and the rate of change just went negative. Evercore ISI, Guggenheim, BMO Capital, and D.A. Davidson all cut their ratings toward neutral or underperform in the days that followed. Being right about the business and being right about the trade are two different tests, and this stock is exactly why. Now let's pull up the options chain and see how it repriced. I'm looking at the September 11th expiration 33 days out with the stock at $13.80. The new at the money strike is $14. The 14 call is bid 85 cents, ask $1.03, implied volatility around 59%. The 14 put is bid 78 cents, ask $1.10, implied volatility around 50%. Split the difference on both legs, and that straddle costs about $1.88 against a $13.80 stock, pricing roughly a 13.6% move either direction by September 11th. Pay the ask on both legs, and you're in for $2.13, over 15% of the stock price just to break even. That straddle isn't free to hold either. Combined, those two legs are bleeding about $2.86 a day to time decay if the stock just sits still. And that's before you're even right or wrong about direction. Notice something else on that 14 strike. The put side already carries 1,775 contracts of open interest. Real positioning built up ahead of the print. The call side has almost no open interest yet, just fresh volume, because $14 wasn't even a strike anyone was watching until yesterday. The whole chain had to rebuild itself around a brand new price level overnight. One more thing worth knowing because it trips people up. Scroll down to the 11 strike call, deep in the money, and implied volatility prints around 96%, way higher than the at the money options. Look closer though. That contract shows zero volume, zero open interest, and a bid-ask spread $1.40 wide compared to about 18 cents wide on the at the money call. Nobody's actually trading it. That IV number is a stale wide quote, not a real signal. The real read on this stock is at the money where the volume actually is. So how would I think about this by time frame? Day trading it, that 1283 low from Friday is the level everyone's watching intraday. Swinging it $14 is the new pivot. The options market is actually pricing around. And if you're thinking like an investor, the real answer doesn't land until the next print, when we find out if that 650 guide was conservative or if the deceleration keeps going. And here's the honest downside case. If Q3 comes in at or below that 650 million floor, that confirms the deceleration is real, not a one-quarter blip. And this stock can keep grinding lower with implied volatility staying elevated the whole way down. That straddle I just showed you isn't cheap insurance. It's the market telling you it genuinely doesn't know which way this goes next. So that's the trade desk. A 21.9% crater to a 7-year low, driven less by the miss and more by a guide that confirmed decelerating growth, and an options chain that rebuilt itself overnight around a 13.6% priced move into September. Same reminder, this is education, not financial advice. I'm not telling you to buy or sell anything. Do your own research, subscribe, and I'll break down the next name on the board and drop your questions in the comments. Good luck in the markets, no matter what stock you're into.